Hello and welcome to Weekend Investing Daily Bytes. We are shooting on 23rd of November, episode number 138. Yesterday we shot a episode on the brief history of market falls, how the Nifty has behaved in the last 2 decades on every fall and how much time it has taken to come back. And today we are extending the same logic to many strategies and seeing that how the strategies behave versus the index and coming back from drawdowns, and we'll showcase 2 or 3 strategies in today's episode. Let's first take a look at what happened in the markets today. So markets opened with a huge gap down. Nifty was down almost 200 points in the very first few minutes, but then from there on it was a climb back for most part of the day, and it was led primarily by metal stocks, PSU banks, real estate stocks, and also the new age Paytms and the other e-commerce stocks, Fino Payments and other e-commerce stocks. They were also coming back today. So although it is too early to say whether the trend has changed, but it was a good dead cat bounce sort of event that happened today, with metals certainly coming back on overseas queue, and commodity stocks also led by Vedanta, which was one of the very strong stocks in the market today. So overall a reasonably good day in light of what has been happening in the recent past. On the indices, as you can see, Nifty closed about 0.5% up, and small caps and mid caps of course were flying much higher at 1.9% and 1.67%. In weekend investing, small cases also, MI35 was up at plus 3%, MI20 at almost plus 3%, NNF10 2.5%, MI25 2.5%. So reasonably very good comeback by most strategies on the weekend investing. So I'll just go through the brief topic that we have on the brief history of markets falls and comeback. So yesterday we saw this, that when Nifty falls more than 10%, and in the last couple of decades there were like these 14 occasions, and these were the drawdowns. So few times it was in the high 30s, 40s and 50%, but most of the smaller drawdowns were in the range of 10 to 15%. So 10 to 15% is the average sort of the normal drawdown you will get in a regular correction, and then once in a while you will have a steeper correction. And all these 10 to 15% kind of drawdowns took anywhere from 1 month to 3-4 months to resolve in terms of Nifty coming back. But of course these larger ones sometimes took very, very long, 967 days in 2000, 698 days in 2008, again 748 days 2010. So this combined period of almost 6 years was probably the most painful. So quickly we want to see that that the drawdowns always come back to zero. So you have a drawdown, but if you stick around and your strategy is good, you will come back. Even index strategy over a very long period has given 14.5% returns in the last 2.5 decades. So I just very quickly want to showcase how the momentum investing strategies are working in similar drawdown periods. So we have taken 2 or 3 examples. First we've taken is our small case MINNF10, which is 10 stocks on the Nifty Next 50 index, and this has had 4 drawdowns more than 10%, 4 occasions on which drawdown was more than 10%, and this the drawdown lasted for a maximum of 279 days, minimum of 59 days, versus the underlying index had 2 drawdowns but of much larger drawdown. So we went to 42% drawdown starting from January 18 and only recovering back by December 2020. So almost 3 years of drawdown, 723 trading days. And in 16-17 there was a shallower drawdown at 13.96%. So if you compare the strategy versus its benchmark, then the strategy was in drawdown for about 17% of the time, whereas the benchmark was down more than 30% of the time in a drawdown more than 10%. So the time spent in a drawdown was much, much higher on the index, whereas the strategy was able to reduce the time frame of being in a drawdown more than 10%, from 30% to just 17%. And the time spent when the strategy was hitting new peaks, that was 18% of the time in the strategy versus 7.8% on the index. So you can very clearly see that despite whatever may be the CAGR numbers, and that of course is also better than the benchmark index, but even regardless of that, the experience of being in a drawdown for too long can be very, very depressing and frustrating. So two strategies where even if the CAGR is the same and you spend less time in drawdowns and more times hitting the highs, you definitely want to go with that, right? So this was the example on NNF10. Then another example on MI20, which is a small and mid cap 20 stock portfolio on a rotational momentum basis. Here again we are seeing that in the index the max drawdown went up to 49.98%. Again almost 3 years here, 740 days. While there was not much of an improvement here, but on the drawdown there was, but not too much in the number of days. And there was another drawdown here at 21%. So in this strategy there's not as much stark improvement, but in terms of hitting new peaks, this strategy was hitting new peaks at 24.7% of the times versus 9.4% in the index, and drawdown time spent was somewhat similar to each other. Then this other strategy of MI35, which invests only in small caps, you can again see here that the max drawdown here is 33.28%, two occasions when the strategy went below 10% drawdown, or higher than 10% drawdown, sorry. But the benchmark underlying went 60.79%, spending 819 days versus 619 on the strategy. And there was another one where the strategy spent 100 days to recover from 15.5, whereas the index took 74 days. So mixed bag here. Total drawdown time spent was 40.5% here and 34.4% here. But again, total time spent in making new peaks was 8.2% on the index and 23.87%. So anytime you have a strategy which is doing better CAGR, having lower drawdowns, spending less time in drawdowns, spending more time hitting all times high, is definitely better than the benchmark indices. So in yesterday's episode we saw that how having a strategy on just the index and regardless of what kind of drawdown came in the last 2 decades, you were able to sail out of it. Also, if you were sipping into that drawdown, you would have scaled up much faster. All these calculations are based on lump sum investments. So if you were sipping into any of these, this would be much earlier than the lump sum investment would get out of the drawdown. So definitely first step, index is very good. If you want a long-term strategy to continue investing, and after each drawdown you will see that you are able to come out of it reasonably quickly. And if you compare it to strategies, then momentum strategies will provide you even a better CAGR, a lower drawdown time, a lower drawdown, and higher time spent on winning days. So both behavioral point of view as well as absolute CAGR point of view, absolute drawdown point of view, the strategies win it hands down versus the index. So this was a short point I wanted to make today. Thank you so much for watching. I'm putting up all the links to the previous day's daily Byte below. I'm also putting links to all these 3 strategies in case you want to go subscribe to them. Thank you so much for watching, and I'll see you in another video. Bye.